With that, let's get you the larger picture. Joining us is our market master for the morning, Rakesh Arora. He's the head of research India at Macquarie Capital Securities, and he joins us ahead of their investor conference. Good morning, Rakesh. Good to have you with us.
Good morning.
First up, what's the mood like with FIIs? We are probably doing well even without them, but are they still going to shun emerging markets in India? Was that what you picked up when you were inviting them for your conference?
Well, Lata, we have the highest ever turnout in the last so many years we are holding the conference. We have almost 250 investors, and almost half of them are foreign investors. So that tells you that, India does remain on their radar, and firmly so. There have been some emerging market outflows, and India has been at the receiving end, being part of the emerging market group. But I think India is separating out a little bit and standing out, and whoever we are speaking to is clearly, looking at India very closely. Markets have corrected, and I think we should see some buying come through from FIIs also in the near future.
Okay, Rakesh, hi, good morning. That's very good to hear that the turnout at your conference is so high. I'm sure you've interacted with a lot of these FI investors before the conference began as well. What's the sense you're getting about the growth pockets that they have identified in our own markets?
Well, the general consensus was that government is moving in the right direction, though growth has been slow to pick up. And partly you can blame the global, worries which have been actually pulling India back. But there are few pockets where, they are very excited to invest. One is definitely the government-led infrastructure, where roads and railways, we are seeing a lot of activity happening. Secondly, I think most of the investors are keenly watching government on the 7th Pay Commission. Recently, government did, that OR, the Army Pension reform. Yeah. So that has really, set expectations for the 7th Pay Commission in the second half of 2016. And urban consumption is one theme which everybody is watching very closely on back of that. Apart from that, given the divestment program has been a little bit slow to take off, a lot of investors are also looking at a high dividend yield from some of the companies like Coal India and MDC and the Sun Zinc. So these are a few themes which seem to be working and where investors are focused on.
Okay. Well, we got this 7th Pay Commission, if you can call it a leak, that it might increase salaries by 15%. Some people said that's lower than previous increases, or at least lower than what some people in the market were spoiling for. Will you be disappointed?
Well, see, the range which everybody is talking about is 15 to 20%. So 15 does seem to be at the lower end. But it's still a huge amount of money which is going to come. And even at 15%, we're expecting around $8 to $10 billion of, higher disposable income. And which is good enough in this kind of environment to kickstart the sluggish demand that we are seeing across sectors.
Okay. In fact, I was just going through a couple of the top large cap and mid cap picks that you have. It's a very interesting bunch, especially in the mid cap picks, because some of these stocks like Strides, Arcolab that you hold are names that continue to hit new highs day after day. What do you do with stocks like these in case you have not, jumped onto the bandwagon? Is it too late, or is there still a lot of upside left?
See, one thing which will not be material enough is going to be valuations if the companies are delivering growth. So growth is definitely at premium globally. Any company consistently delivering growth in current environment will be valued at a very high PE multiple. So we continue to advocate that it's not really a wrong time even to get in now, because market will continue to reward companies which are consistent and growing despite the economic environment.
Okay. Rakesh, from the year that was, that previous 12 months, the Nifty has not given us much gains, but some leaders in the Nifty have. So what would be those pockets that you will bet on for the next 12 months?
So, clearly, the themes that we discussed are the pockets where we want to be overweight. So we are overweight on consumer discretionary as we expect urban consumption to pick up.
Okay.
We are overweight on industrials as we expect, execution on the ground for roads, railways to pick up materially. We are also overweight pharma, given the drubbing these stocks have got some of the large cap on FDA worries. We think that those worries would have already been factored in, and these companies are on back to their secular growth path. So these are our three big overweight sectors. We are neutralish on banks, but we are overweight on private versus PSU, so that theme continues. IT, we are slightly neutral to negative. So two large sectors, I would say we are neutral to negative, but we are finding growth coming in some of these smaller sectors. Also, would say that it's more of a bottom pick market right now rather than, buying the market wholesale, as we have seen last year. So stock picking becomes very critical even within the sector. And one should stay with, companies with consistent growth profile.
But in some of these sectors like capital goods and infra, Rakesh, patience has not rewarded investors. I mean, if you look at the stocks in your own portfolio, names like L&T, Crompton Greaves, there's been no sign of recovery in earnings just yet. How long do you think it would take for some of these companies to show a recovery?
Yeah, see, you have to view this in, in a way that last year there was a very high base effect which came into play. So L&T had already jumped from a 700 rupee level to 1400 without anything happening. So people were, looking for some signs. Stock was consolidating, and now, orders have been given out. We think execution will pick up. So this is the year when returns, should come back in those kind of stocks. Crompton is more event-driven, and the events are likely to play out over the next 2 to 3 months. So we remain very confident in our stock picks. There's definitely catalysts which are coming up, and which would really lead to re-rating of these stocks.
Okay, another stock that you have in your portfolio is TVS Motor with a target price which is much higher than the current market price. Do you think this is a better option compared to the larger peers like Bajaj and Hero MotoCorp, and what's the trigger there?
Yeah, clearly, TVS has been doing much better because of their scooter portfolio. Despite the weak, demand for the sector, they've been growing their scooter volumes at 12 to 15%. And now we are excited about their new launches in the motorcycle space, plus their JV with BMW. So, and in the last quarter, as you would remember, the company surprised positively on the margins. So we're expecting, margins to keep growing. They're gaining market share in scooters, and overall, the perfect mix that you would like to have from a stock in the next 12 months. So basically, TVS does remain much better than its more celebrated peers.
You spoke about, this road construction. I think it's also one of the themes you'll discuss in your seminar, right? Roads, the brightest spot in the infra space, is a theme you're discussing. Is L&T the only kind of play? I mean, there are others who are cleaning up their balance sheets. Would not the mid-cap road contractors be on your radar?
Obviously, L&T, among the large cap, there's no one apart from L&T. And but in the mid cap, we are pushing Sadbhav Engineering as our top pick. We are pushing IRB Infrastructure. We are pushing Ashoka Buildcon. So there's a lot of stocks in the mid cap space in the road sector that we really like, and continue to recommend investors to look at them.
We have this much celebrated Uday reforms for power discoms. Any stock that you will buy because of this? Actually, the market only sold off after that day. They sold off PFC and REC. But in the longer run, anything is a buy?
I think the clear buy there is Coal India, because demand for Coal India's coal is definitely going to go up. There's no commodity price risk, and dividend, if any, can actually go up only from where they are. So a 6% plus dividend yield, volume growth of 10% plus, I think that is the stock to really own. People might wait for FPO, etc., but the stock is not really falling as much. And even in the last time FPO, we saw that the stock didn't really go down at all. So I think Coal India could be one stock which one can look to buy on any kind of dips here on to play this whole power reform. It's
power generators?
It's difficult to play through the power generator. I mean, NTPC obviously is a big beneficiary and is one of the safer bets. But I would say that be careful about some of those mid-cap power names, because the problem might be running too deep out there, and it could be a little bit of a value trap. So stick to large liquid names like Coal India and NTPC would be our call.
Okay, so stick to Coal India and NTPC. Those are two recommendations there. You have a very interesting banking panel at 4:30 today. How can banks best deal with the NPA situation? That's the million-dollar question, is it not? But in terms of individual stocks, what are your top recommendations in banks, both from frontliners and from mid-caps?
So since we are trying to play the whole, urban consumption boom, so retail banks feature prominently into our picking. So HDFC Bank is our top pick out there, and we also like IndusInd Bank, Kotak Bank. So all the retail-oriented banks are where we are overweight. We are underweight on most of the PSUs, apart from SBI. So SBI is the only, PSU bank which features into our list.
Okay. The Nifty didn't do anything in the last 12 months. What will it do in the next 12 months?
Well, see, there are a lot of catalysts which are lining up. So obviously GST is a big catalyst which can immediately lead to re-rating of the market, and let's wait and see how the winter session of Parliament goes. Then, we have all these seventh pay commission noise coming in that will really prop the growth expectations. And I'm hoping that consensus would also cut their numbers fast enough so that we are done with the earnings downgrade cycle. And, companies start to deliver on the expected lines.
What is your earnings for the current year and the next?
So we are assuming around 8% earnings growth for FY16, 10% for FY17 and 15% for FY18. And, that drives our target for Nifty at 9,200, which is a good 17-18% upside from current levels. So I think if I try to do a worst case scenario in terms of 12-month target, it comes to at 8,100, which is still an upside from the current levels. So clearly, this market is buy on dips. All the negatives are already factored in. And once we start to see some positive catalysts, the market is going to zoom up.
Okay. Well, one final question then. You have a panel on real estate as well, which is titled A New Dawn. Are you factoring in some sort of recovery in the sector, and are there any stocks that one can look at?
Or did you mean a new DON?
Well, real estate is seeing some exciting times. There are a lot of, pension funds who are looking to come to India and invest into real estate. And the recent FDI norm relaxation is also going to help in a big way. Plus, we are still yet to see the REITs come through. There are some clarifications required there. And with the urban consumption theme, I think real estate fits in pretty well. We continue to like companies like Prestige Estate, Shobha, Oberoi. These are our preferred names, and also Godrej Properties. So there are few names that we like, and valuations are really, really cheap now. And I think investors can start to look at this sector again.
All right.
Rakesh, thank you very much for joining us on what is a busy morning for you. Have a great conference out there. We'll touch base with you and your team after you're done.
Thank you. Thank you, Lata.
Well, it's certainly a nice backdrop that Rakesh is sitting in. I mean, some green in Bombay is a pleasant sight. Okay, green on the screen in only, just about 10 minutes of red is all that we saw.